So again, some of you are clients, some of you are friends, some of you are people that have just been introduced to us through the different platforms that Wealth Builders is on. So we want to thank you for being here. A couple of rules. I'm going to keep you on mute. I'm going to go through the PowerPoint presentation. You'll get a copy of that afterwards, along with the recording. And then if you have questions, feel free to enter them in the chat. And I'm going to leave a few minutes at the end to answer any of your questions. And if I don't get to them, just because we started a little late today, then I will personally respond to you by email to answer your questions. So if there's something on your mind, feel free to ask those questions in the chat. So, all right, well, I'm going to start our presentation here. Again, this is our August economic update. And a lot going on this summer, even though summer in the markets are usually pretty quiet. This summer's had quite a bit of things going on with the Federal Reserve, with some credit rating downgrades of the U.S. government and of some banks, which just came out this week, actually. So pretty exciting stuff. So let me jump in here, and we will get started there. So again, wealthbuilders.net is where you can find us. Many of you already know that, how to get in touch with our team. Again, I'm Chad. We've got a team of advisors in Colorado and Texas and California that work with individuals like yourself. Again, our attorneys want us to put in our legal disclosure. Again, this webinar for educational purposes only. Again, we are a registered investment advisor. Our parent company is called Authentic Counsel, LLC, and we do business primarily as Wealth Builders Investments across the country. If for those of you who are not familiar with us, and even for clients, you can go to the SEC's website here, this advisorinfo.sec.gov, and you can read all about our registrations and our profiles and summaries. That's a legal document. If you are interviewing financial planners, advisors, I always encourage people to go to the site just to familiarize yourself with the company that you're potentially going to work with or are working with on that. So again, just a resource that's out there through the SEC, which is our main regulatory body. For those of you who don't know, we do a weekly podcast show. We drop an episode every Tuesday. It's called the Kingdom Finance Show. If you want, take a picture of this QR code. I will leave the slide up for a minute. And this is a great, well, I'm a little biased, but I like this. I really want to encourage you to take a picture of that QR code and subscribe to it, because what we do on the Kingdom Finance Show is we take what's going on in current world events, geopolitical events, in the economy, in the markets, and we evaluate it from a Christian worldview perspective. And so we really want to distill the chaos and provide clarity to you, and just give you some tangible thoughts on what we're thinking as we pray through the capital markets and as we talk to people all over the world about what they're doing to invest with biblical values. So that's a great way to follow us. This webinar we're hosting, we do monthly. We go into a little more detail here than we do in the Kingdom Finance Show on things like how are we investing. So really, if you're a client, this webinar is for you, because this is where I'm going to really kind of show you what we're doing in the kitchen. Now, if you're not a client, that's okay. We like everybody to come to these webinars because it gives you a feel for what our company does and how we work. And if that's something you're interested in talking to us about, we would be happy to. So that's a great one. Every Tuesday, we drop a new episode. I just recorded an episode this week. There was about 10 different banks that were downgraded for their credit. And we think that's part of the harbinger for the economic recession. I just recorded an episode, I think yesterday, on that. So a lot of good content in there. But let's get right to the slides. I've prepared a lot. I'm going to cover all of them. I know we started late, but I'm going to talk fast. We are recording this. I will have all the PowerPoints available to everyone. And if you have questions, please feel free to put them in the chat. Okay, so this is our client market report update for August 2023. Get that slide there. Okay, I love this quote. I ran across this quote really just recently. The more disciplined a team exercises, the more freedom that team will have to maneuver. And this comes from a book called The Dichotomy of Leadership. And I read this, and it's a secular leadership book, and I thought, there's a lot of wisdom in that parallels to Scripture when we think about having a multitude of counselors, when we think about walking in our spiritual gifts, and when we talk about walking with God as we make decisions for our family and our businesses. But the more disciplined a team exercises, the more freedom they will have. So one of the things at Wealth Builders Investments that we're real particular about is we're going to have a disciplined approach to what we will invest in and what we will not invest in. And so much like the game of chess, there's strategy to that. Now, our philosophy is a little different. Our disciplines are different from Wall Street. They're going to be different from traditional advisory firms like Merrill Lynch and Edward Jones and Vanguard, because we're looking at things in the capital markets, stock market, real estate, gold. We're looking at all those things with a kingdom perspective of how do we manage these things? How do we make choices and be good stewards while making market rate returns? So I thought that was really good, just to put language to the more disciplined we can be in what we're doing at Wealth Builders Investments with many of you as clients. Then that's actually going to give us freedom to say no to certain things, which will make our yes more powerful to say to other things that are in alignment with our values, or that are very good opportunities. Because let's face it, it's like going on vacation, right? We're here at the end of summer. Many of you have gone on vacation. I know we did. You can't go everywhere in the summer, right? You've only got so many days that the kids are out of school, that you're off work. And even if you're retired, you only have so much money in your budget to travel. Same way when we think about financial planning, when we think about charitable giving, when we think about investment management, we have to be disciplined, because we can't focus on every single thing. And so if we can be really good or really committed to 4 or 5 different things, then that's going to give us better results, we believe, in the long run. All right, I'm going to show probably 6 or 8 charts. There's a lot of detail on these charts. Please don't be overwhelmed by them. You're welcome to take screenshots, but again, I'm going to send these out as soon as we wrap up. I'm going to push this out to everyone. But let me give you a framework for how we look at the capital markets. So when I say capital markets, just so everyone's aware, we're talking about all the different asset classes. So whether that's the stock market, the bond market, the commodity market like oil and gas, gold and silver, real estate, things of that nature. There's really, I've got 2 charts here that are color coded, that if I were teaching this at a business school, which I've done before, then I will show a couple of slides just to give people perspective. So this framework is a high level, 30,000 foot level, but I like it because it's color coded from left to right. So you'll see from left to right, it's dark red on the far left, and then it kind of goes pink, orange. In the middle, it's yellow, and then you go dark green. So obviously, using the stoplight analogy, red means this is negative, green means this is go, yellow is neutral. So we have 4 categories here, and this is our framework for how we invest. So this is helpful. Some of you as clients may have not heard me unpack this. Some of you may be new to our group, and this gives you a little idea on how we do the recipes in the kitchen. And so we have trend, and the trend is your friend, and that's the saying that Wall Street has. And so the trend is your friend. So if the general trend You can think of this as if you're out on a sailboat and the wind is blowing. That's the trend. Whichever way the wind is blowing in the general economy, then that's the way we want to invest. And so, depending on if things are generally positive, mildly neutral, extremely positive. Now, what you see right now is this is the short-term trend as things are fairly positive. Now, that's a short-term trend. So it just means right now, in the stock market, for example, stocks are actually up. We don't think that is sustainable, but the trend right now is fairly positive over the summer. The trend. Now, the number two part of the framework is the Fed. So this is the Federal Reserve. It's the central banking currently led by Jerome Powell in the United States. So unless you've been living under a rock, you know that they've raised rates a number of times since March of last year. And that is currently a negative score. So you'll see that there on the left-hand side. Now, why it's negative is because interest rates are very high, money is tight, credit is constricting. So it's more expensive to buy things, right? And we've got inflation. So that's a negative one. The third factor is the overall economy. So 2/3 of the economy is what everyone in this room spends. So whether we're shopping at a grocery store or Best Buy or the hardware store, taking trips, buying clothes, eating out, 2/3 of the economy is consumer spending. So right now, the economy is more neutral. It's not overly negative. It's not overly positive. It gets more of a neutral rating here. And then the fourth factor for our framework is valuations. So valuations just means how expensive is it to buy real estate? How expensive is it to buy stocks, mutual funds? And so the valuations go from high to low to what we would call fair value. So right now, valuations, as you might expect, are very high. So when valuations are high, that's a negative factor because that means that things are more expensive. If any of you and your family have been buying real estate lately, either as your personal residence or investment property, or if you've been picking individual stocks in the market, you know that a lot of these prices are still very high. Even with interest rates going up, real estate prices, because of supply, have stayed very high. So again, Warren Buffett is the most famous value investor. I'm going to show you a chart here in a minute. But this is negative. So what that means is that we're not going to go all in on stocks or real estate right now because things are very expensive. So that's the 4-factor framework. And let's talk a little bit about the Federal Reserve, which I just mentioned on this slide. And if you've been with us in June or May or any of our other webinar updates on the economy this year, this slide should look familiar. I update it every month. And so these are the different meetings for the Federal Reserve. And you'll see they've been raising interest rates 1/4 point. In June, they held. They did not raise rates. They didn't cut rates. And then coming back here just a couple of weeks ago, they raised rates once again. Now that's why we're negative on what the Federal Reserve is doing, because for some of you who have lived through the 70s and the 80s and the 90s and being aware of the financial markets at that time, you know that historically, the Federal Reserve either over tightens too much and then something breaks, or they keep money too loose until things get too saturated. So right now, what the Federal Reserve is doing, we view as negative, because the more tightening there is in interest rates, that dictates the supply of money out in the economy. So whether that's through banks to lend on mortgages, I've heard story after story of people who are having trouble getting mortgages approved because of underwriting in banks. They're getting tighter because money's getting tighter, and so their underwriting is getting tighter just the same. So the telltale sign right here, if you're keeping score at home, is September 20th. I'd mark that on your calendar. That's going to be a really important date, because what the Federal Reserve announces on September 20th, I think, will have a really key impact on what happens in the markets this fall. Now, if any of you know, September and October are two of the most volatile months of the stock market. So generally the summer's pretty chill, right? It's pretty calm, lower volume. But big news, for whatever reason, is usually comes out September and October. And I think this date right here is one date we're really looking at on that. What is the Fed going to do? I talk about this on the Kingdom Finance Show as far as a soft landing. I think the more they're going to tighten more, but we may likely have a big harbinger event or a black swan event. I think that could come from the credit system, and that's going to make the Fed have to make some difficult decisions. This chart here, again, I've got several charts in here, but this chart here, let me just unpack this briefly. The blue line, if you see the blue line, this is the what we call the yield curve for interest rates. And so this is the short-term rate. I'm not going to get too technical on it, but what this is telling us is this is what currently the bond market, this is from Bloomberg. If you look at this blue line, this was as of July 27th, 2023. So this is really fresh data. This is the short-term interest rate. It's what's called the implied rate. And if you'll see at the bottom of the chart, if you can see that, it shows it going out over the next 2 years. So going out through the end of 2025 and even into the first quarter of 2026. So Chad, what does this mean? What it means is that currently the bond market, which is a good indicator of future economic success or struggles, is saying that short-term rates are going to stay high, right? You see that blue 5.24, 5.42, 5.1. And if I look at the date, this is implying that interest rates are going to stay elevated well into probably around March of next year. So the common question we get at Wealth Builders Investments is, well, when are interest rates going to go back down? When are mortgage rates going to go back down? Right now, the bond market is answering that question by saying it's probably going to be next spring to next summer, 2024. And you see there that this short-term implied rate starts to go under 5%. And of course, we get out into 2025, we think rates are going to go back down. This is just a short-term borrowing rate that we're showing here. But so for those of you who have bought real estate, you're going to have opportunities to refinance that. It may be 2 years from now, looking at this chart. And for a lot of first-time home buyers, they're going to see mortgage rates get back to more affordable levels, hopefully by next summer, based on the information we have now. All right, I'm going to keep moving along here. Our overall thesis right now, and I'm going to share at the end, so please stay with me at the end. I think 1 or 2 slides on exactly what we're doing in our portfolios. And for those of you that are clients, you're going to recognize some of the things we're doing. I'm going to give you an update on it. And for those of you who are not clients, you're just going to get kind of a sneak peek of how we are managing money, what type of asset classes we like. So I have 2 slides on that. And I really felt like, from talking to our team, because we have so many clients on these webinars, I'm super thankful for you coming. I really want to make sure that I include a personal update to you as clients on, hey, what's the team doing with the investment portfolios right now? Because for a lot of you, it will answer some questions on things in your investment accounts and what we're thinking internally as far as how they're doing. So stay with me to the end. I'm gonna save that at the end. I think it'll be really insightful, especially for clients who are going to be like, hey, I know we talked about oil and gas. What do you think about that right now? This chart here is a lot of data. but this is from a research group called Wealth Shield that I follow. And this just, if you're looking at the color codes on the right, you'll just see red, orange, and then kind of light to dark green. Again, if I can explain this to a fifth grader, then I feel like I know my content. So if I can explain this to my kids that anything in red is bad, anything in orange is okay, and then anything in green is really good on that. So again, if you look at the top here, these are different valuation methods. And 3 of the 4 valuation methods, now for time's sake, I'm not going to unpack what each of them are, but they're listed here. But these are the ones that analysts, certified financial analysts, they're going to follow. These are what Warren Buffett's of the world are going to follow. 3 of the 4 most common valuation formulas are at significantly elevated levels. And then one of them is moderately high. So that really goes back to what I said earlier, that asset prices are still very high. Now, that doesn't mean that we don't invest in assets highly priced. It means that we have to be A, very selective, and it means B, we're not going to follow the traditional Wall Street advice of, well, we're just going to put it in there. We're going to buy the fund and we're going to ride the wave and buy and hold and just trust that Vanguard or American funds or whoever knows what they're doing. When these get to high red levels, what it implies is financial gravity. And so financial gravity just means what goes up must come down. And so red means we'll still invest in assets that are highly priced, and we're doing that selectively. But it also means, and as many of you know as clients, we're going to have a lot of money on the sideline because we're waiting for better prices, better entry points to invest in a lot of our asset classes. Doesn't mean we're not investing. It just means we're going to keep some powder dry, as we like to say in Texas, because the really wealthy people, they make their money when they buy. They don't make their money when they sell. They make their money in stocks, real estate, gold, private companies. They make it on the entry. And so that's something to be very mindful of. And that's why I wanted to include this chart. Okay, again, another one I think I've drilled down on the valuation idea, but I wanted to make sure you see this in a chart form. And so, again, this is just our thesis that valuations are very high. And we think that given what's going on with the Federal Reserve and what's going on in the credit system, particularly in the banks, that's going to lend itself to valuations being tested. And I think that we see a pretty meaningful correction. So let me just point out one thing on this chart. Again, this is my chart of really financial gravity. And this black line in the middle, that's 0%. That's 0. So this is called regression to the mean, if you were in statistics or finance. And so these dotted red lines are standard deviation, but this just means the higher this goes, this is how much of an outlier or how much overvalued. So back shortly after COVID, this gray line here, this gray vertical line, if you can see, that was COVID. So that was March, April of 2020. Valuations were at 162%, which means that's how overvalued asset prices were. Now it's come down. In 2022, the markets came down, but we're still sitting at about 114, 115%. And this is just the average of them. Overvalued. So again, if you have assets that have done well, this is a great season to be taking gains, harvesting gains. Ideally, if this purple line gets more down here to around 50, 75, 50, then there starts to be some better buying opportunities. Now, of course, when this line goes down below my black line, then that's when we say you back the truck up, because that's when asset prices are on major fire sale. So if you go shopping and you get a coupon that says, hey, everything 50% off, that's these periods when this chart is below the black line. Now, interestingly, in the study of behavioral finance, a lot of investors get too emotional when it comes to greed and fear, and they're a little fearful, and understandably so, to buy assets, real estate, stocks, gold, when they're on sale, and they prefer to buy them when they're at a premium. And so that becomes the old adage that the everyday investor buys high and sells low, and the astute investor does the opposite. So this chart, again, just giving you a little data on where we are in the economy. I do think, and particularly if you listen to some of our episodes on the Kingdom Finance Show, what we think's coming will lead to a correction in these asset prices. And I think personally, and what we're doing for clients at Wealth Builders Investments is we have some dollars invested, but we have companies picked out that we want to invest when they get down here under the 100% valuation, somewhere in that 50 to 75. That's when we're going to be buyers. All right, I think I have one more chart, and then I'm going to pivot to share with you what we're doing in the portfolio, and then I'll end with answering questions in the chat. So feel free put some questions in the chat. If you have questions on what's going on in the market and the economy, I'll be happy to answer those. Okay, so this chart, I've followed this group for quite a while. It's called it's a GMO, research firm based in Boston, highly thought of in their institutional research. You can go look them up. I don't invest with them. I just follow their research. But what this report, they do it quarterly. So I'm sharing with you the most recent quarterly one they did. Now, what I like about this is like taking a pair of binoculars and looking out over the next 7 years, looking both in the US and internationally and in emerging markets at valuations and what are the projected returns for different asset classes. So let me just walk you through this a little bit. Again, these are traditional asset classes. This doesn't include some of the other alternative asset classes we invest in. But let's look at stocks. So over the next 7 years, it's projected that US stocks, US large cap stocks, will have a negative 2.6% annualized rate of return over the next 7 years. And the question might be, well, Chad, why is that? The reason is that valuations, right, are very high in the US, and with potential headwinds with interest rates, government debt, that US stocks will most likely underperform international. So that INTL stands for international stocks, and in particularly emerging markets will outperform. So what this study tells me is that as of right now, this was as of the end of Q2, that international companies and emerging companies have lower valuations. It means they're cheaper than US companies. And when we're designing a portfolio, so if you're thinking about what to have in your IRA, your 401k, or your brokerage account, it means it doesn't mean you don't invest in US stocks, but it means that you probably want to be mindful. Again, we're looking at over the next 5 to 7 years. You want to be mindful of investing in international and emerging companies in the coming year because they are cheaper. They're on sale. Okay. And same way on the right side of the chart, bonds. Over the next 7 years, it's projected that emerging market bonds will perform better. And interestingly enough, cash Again, just short-term cash management. Again, these are not huge numbers, but again, we're just looking at projections for that. So my takeaway there, if you're rebalancing your IRA, 401k, or if you're wondering how we're going to be rebalancing them, we're going to be looking at adding international and emerging market companies in the coming year. Doesn't mean we're doing it today, but it means this is a forecast, and we're going to start looking bargain shopping in some of these other asset classes that are outside the United States. I'm going to skip ahead. I'm going to skip that chart just for time's sake. One thing that I mentioned in my podcast this week, again, wanted to include this just to make sure everyone's educated on inflation, because what the media is reporting, what the government is reporting, is that inflation is down to 3%. Well, yeah, it depends on what you're measuring, right? Now, I don't think I need to spend much time on this, but we're here at the end of the summer, and let's look at some of the things in their inflation rates. Now, it's summertime, so a lot of people are traveling, but oil prices are up 18.5% over the last 30 days. And in fact, energy stocks have been up. Again, a resurgence in energy stocks. So we like energy stocks, and we like private oil and gas. I'll talk about that in a minute in the portfolio update. For those carnivores at home, cattle prices are up 22% over the last 3 months. And if you're going to put your burgers on a grill this summer with your propane tank, propane's up about 37% in the last 30 to 60 days. So I think all of us know innately that prices have gone up. So our thesis, we don't actually agree with the government reports that, oh, inflation's under control. We think in managing your resources with Christian principles, we need to be mindful that prices are going up. So oil and gas is still going to be needed. There's a lot of commodity prices that are increasing for business owners, franchise owners, which we have many clients that are of that. And so this just informs us that what the media is reporting, well, there's a little bit more under the hood to understand about, well, is inflation really going down on that? So wanted to point that out. I'm going to skip that chart for time's sake. This is a really good chart. I'll cover that one next month, but it kind of goes along with what I'm talking about today. Let me finish with this chart, and then I will do investment portfolio update, and then we'll see what questions there are in the chat. This one's very similar to the first chart that I had, but I found this from another resource. And again, it's kind of the red light, green light idea. Again, this is from a different research outlet, but it just confirms our thesis in that the trend right now is positive, but what's going on with the Federal Reserve, what's going on with valuations, what's going on with the overall economy is negative, negative to neutral. In the other chart, it was neutral on that. So this is another way we present that. If these lights are all green, then that means as a portfolio manager, we're going to be really aggressive in how we invest your resources. When these have 2 reds or more, then we're going to be more cautious. And of course, if there's 3 to 4 reds, when this trend turns red, there'll be a lot of money, institutional money, that's going to jump out of the market. Because what a lot of institutional money managers do is they buy with computers, and as long as the trend is green, they're going to be buying, and they might buy and sell in a week. And these are institutional hedge funds on Wall Street. When this trend turns from green to red, that is usually when people lose a lot of money, because when all 4 lights are red, asset prices can typically go down 15, 20, 25% in a matter of weeks, right? I mean, we've seen that in past cycles. Now, a great question, and if it's not already in the chat, I'm going to answer it here, is, well, when are we going to know, or what's going to need to happen for the trend to change? it will need to be some type of harbinger event where, now catch this, where consumer sentiment, the sentiment of us as investors changes. That could be something geopolitical. That could be something happening with banks, and more of a credit crunch on more banks foreclosing. Those are two really common ones on that. Again, geopolitical, it could be something with Russia and China. It could be things like that. But this doesn't change. Let me put it another way. It changes quickly. Sentiment can change from a Friday to a Monday if something major happens over the weekend. So we want to be mindful of that as money managers and financial planners on that. All right, let's talk about the portfolio. I really appreciate everyone being here. Again, I'll send these slides out to you. If you've spent any time with me one-on-one, you know I love this quote. King Solomon, wealthier than the 5 wealthiest human beings on the planet today. Right? If you took Elon Musk and Zuckerberg and Buffett and Bill Gates and Bezos, and you added all their net worth together today, in today's dollars, King Solomon's still worth more. And he said in Ecclesiastes 11, I think this is the NIV, but invest in 7 to 8 different ventures, for you do not know what disaster may come upon the land. And that's one of our major guiding principles at Wealth Builders Investments is we're not just going to take the traditional Wall Street advice and just do a stock and bond portfolio, mutual fund portfolio. There's something wrong with that, but we do think biblical wisdom says you need to be more diversified. You need to manage protecting the capital better on that. So I'm going to give you, I think, got 3 more slides with that verse in mind. And here's our current market thoughts. And again, this is really for clients, but I recognize some of you aren't, but this will give you an idea of what we're doing in the kitchen, so to speak, with our portfolios. Some of this is a summary from what I've presented, but I want to condense it here at the end. Our current market thoughts, we think emerging markets and international stocks are getting ready to offer very attractive long-term opportunities. Now, I cited that in my chart. We think the S&P, just buying the market is a recipe for, well, this says it nicely, underperformance. I think that's a recipe for disaster because I do think we can easily see a 20% correction this fall in the S&P 500. So we like the prospect of emerging and international stocks. So that's something we're going to be digging into more to add to the portfolio. Tactically speaking, we like energy and we like value. So by value, I mean publicly traded companies or private companies for that matter that have really strong balance sheets and they pay out dividends back to their shareholders. Really strong earnings, and they're paying those dividends out as distributions back to the shareholders. Technology stocks are way overbought, and we think a correction is underway in the technology sector. If you've been following the NASDAQ, there's been a lot in the news about AI, artificial intelligence, and NVIDIA and others. We invest in that space, but we do think a correction is underway because those feel really overbought when we look at them. Based on the economy, we really feel like high quality and dividend growth stocks, as well as lower volatility investments. Those are called factors. So when we're in the kitchen building portfolios, this is what we're looking at: quality, lower volatility, and dividend growth investments. Bonds are negative with interest rates where they are. We definitely like fixed income investments right now. And for those of you as clients, you're gonna notice this. The fixed income we're buying is shorter term, so we're 6 to 12 month range on a lot of that, and we're also keeping a lot of liquidity for buying opportunities. We have a preference for having liquidity right now. All right, let me wrap up. We'll probably go 5 minutes over, and just out of respect for time, I want to make sure we do that. So here's our portfolio update. Again, for clients, you're going to recognize some of these asset classes. in here. On the equity side, we're liking high quality, dividend focused. We also do the pro value screen. So we are screening companies for what type of impact they're having on their employees and their community. And we're specifically looking for companies that don't violate First and Second Amendment rights. We're looking for companies that do not expressly use their earnings to promote the left-leaning liberal socialist agenda. That's growing harder and harder. But right now, overall, we are underweight in equities just based on valuations. Fixed income, I've already mentioned this. We're focusing on shorter term, primarily U.S. Treasuries and FDIC insured CDs. So you're probably seeing those in your portfolios. On the private investment side, private credit and private equity, let me just mention private credit. So we're finding a lot of value in the private debt market. And so there's different types of private fixed income investments, which we talk about with you as clients. I won't share the managers on this call just because we have a mix of people, but we're having a lot of success there because private credit is really needed for small and medium businesses right now. And so those strategies were generating 8 to 14% annualized rates of return there. So we're really happy with that because that is above inflation. We want good inflation adjusted returns. So private credit's been a real winner this year for us. And for clients, feel free to reach out to Caleb or myself and just ask us, hey, who is it we have that's in the private credit market? We'll let you know, send you all the information. That one's done really well. Really pleased with that based on what's happening with interest rates. Real estate, we obviously invest in real estate in the portfolio. And I know many of you invest directly as well. There are still geographic opportunities. They are pretty challenging because of valuations right now. But we still have a pretty strong allocation to real estate. Right now, we're looking at some different opportunities in some of the more red states, if you will, Texas, Florida, Arizona, and a few others. Oil and gas, we're still really bullish on oil and gas. We think that private investments in oil and gas present a major long-term capital opportunity, and they also provide really good tax benefits. So we've been deploying some money this spring and summer into some private oil and gas developments that we have followed for years, and some that I personally invest in. So those are really good. We call those non-correlated because we believe there's always going to be a market for oil and gas, and the private producers of that are the ones we would prefer to invest in. The last two asset classes are more the non-correlated ones. For time's sake, not going to delve too deep, but we do some work in the wildlife conservation area, which is, again, non-correlated, economic resilient to recession, and provides some great tax benefits. Conservation investments have gone extremely well. That would be a mild understatement. We're seeing some major double-digit appreciation in that asset space. And then the last one, private equity, and I'm going to end here, and then we'll check out a few questions. And private equity, we are finding, and this I'm really excited to report, we're finding a lot of private companies all over the world, U.S., South Africa, Indonesia, and parts of Europe that are Christian men and women running these organizations, and they have a phenomenal business models, and they are making meaningful impact for the kingdom. They're what we call pro values, but these are amazing businesses. I mean, if you just looked at them on paper in a business school, you'd be like, that is a good one. And they actually have a kingdom impact component. So we are looking at some more private equity opportunities here at the end of 2023 and going into 2024. We've got some really good opportunities there. We'll be sending out a separate webinar invite to tell you more about some of the kingdom impact investments we're doing in private equity. And some of that is really going to blow you away. At least it did me. These are things like fighting human trafficking, arts and media and entertainment, not to mention a host of others. So that's one we're really excited about. And these are long-term opportunities that provide really high rates of return for the patient investor, but also are making an impact for the kingdom. So that's our summary on the investment portfolio. That's kind of our major asset classes that we're investing in for our clients. And I'm going to check the chat again. You guys know how to find us. Really appreciate you being here. Let me pull up the chat here and see what kind of questions we have. We are recording this, so you'll get, if you registered, even if you dropped off, everyone's going to get the recording along with the slides. Is this a good time to sell stocks that you do not want right now? Yes. Short answer is yes. Again, it does depend on if you have tax consequences for selling it, but I can tell you that as we have clients we've started working with this summer with valuations, the S&P's back up over 4,500. That's been a great time for us to sell out of companies like JP Morgan or Target. Well, maybe not Target, but I would sell out of it anyway. But JP Morgan and some of these other companies that are woke that we don't want to be in anyway, we're going to be getting out of those. Is now the best time to sell real estate? It depends. If it's investment real estate, I think investment real estate, it's nothing wrong with floating, kind of going fishing and putting the price that you want. If you've got a house you're renting out and you want to sell it, and you have a price in mind to go fishing to sell it, and if you can get a buyer. If it's a primary residence, that's different. Obviously, we found for a lot of first-time home buyers, they're having a hard time, and they're probably going to have to wait until next spring or summer when there's more supply and hopefully mortgage rates are lower. Let's see what else. Yeah, digital currency. Yeah, hey Connie, thanks for the question. I think digital currency is a reality. We have invested some in digital currency, but honestly, it is so stinking volatile that our clients have found it almost, like the hottest hot sauce you can have. It's just too volatile. I do think, public knowledge that the Federal Reserve of New York is doing a study with major banks, Bank of America, JP Morgan, on a digital currency system. I think there's a lot of negative with that. I think a full-blown central digital currency system is going to become like spyware, where they track what we're doing in purchasing, which the whole point of blockchain was to decentralize that and create privacy. So, I do view Bitcoin and Ethereum as a viable asset class. It's just really volatile. So we will see kind of what happens with that movement. But I think that's here. That is here and going to continue. Let me just say real quick, and I'll let everyone wrap up. I know we went a little long. I really appreciate your patience. Apologize for the technical difficulty. All right, I think we covered most all of them. I don't have any advice on buying land in Mexico, but I'm not the right person to ask on that. But I think overall, in summary, just let me wrap up for 60 seconds here. And then if you have additional questions, please email us info@wealthbuilders.net. And then one of our team members will get back to you. If you're clients and you have questions on your portfolio or portfolio access, please let us know. And then for those of you that aren't clients and you just want to learn more about what we do offer a 15-20-minute complimentary consultation. Happy to talk with you, learn more about where you are and if we're a good fit to assist you. In summary, I think as we move into September, we're going to see more volatility in economic news and in the markets. And so I want to encourage us to, again, just like Solomon, we want to think differently. We want to be looking at different asset classes, but I do think liquidity is key. I think asset prices are going to start to come back down this fall, and September 20th, what the Fed does there, I think will have a major major implications for how the rest of the fall works out. Well, hey, this has been a blast. Again, thank you for your patience. Thank you for being here. We do this every month. So if you got an invite to this, you'll get the invite for next month. And we'll do that on the second Thursday of September. And then check out the Kingdom Finance Show podcast, and feel free to reach out to us with any specific questions. And again, I did just record a great episode on the banks. That'll be coming out next week. I could have talked the whole hour on what's going on with the banks for that. So, all right. Well, thank you all. God bless. We wish you a great rest of your summer, and we will see you next time. On behalf of Wealth Builders Investments, thanks so much.